You're listening to ALTLOOK, the Alternative Investments Podcast, a series from Kroll focused on key market, valuation, regulatory, compliance, and other nuances of alternative asset investing from various perspectives, including those of fund managers, general partners, investors, limited partners, regulators, and other interested parties. In our third episode, Kroll's David Larsen speaks with Ross Hostetter, Kroll Managing Director, about the impact of private investments being available through target date funds, 401ks, 1940 Investment Company Act, 40 Act funds, Collateralized Fund Obligations, CFOs, and other investment vehicles.
I'm David Larsen, a Managing Director in Kroll's Alternative Asset Advisory Practice and a member of the Kroll Institute. As a reminder, we have recently rebranded Duff & Phelps as Kroll. I'm joined today by Ross Hostetter, a Managing Director and leader of Kroll's U.S. portfolio valuation practice. Ross and I have worked together as part of the Alternative Asset Advisory practice at Kroll for over 15 years. Welcome, Ross. It's a pleasure to have you with us today.
Thank you, David. Good to be here.
Over what is fast approaching 2 decades of working together, we've gone through a number of name changes as an entity. Our firm has grown tremendously over the years, both organically and through acquisitions. And most recently, or just I guess it's a few years ago now, that we acquired Kroll in 2018. And as our products and services have grown, so too has the number of brands which we were using. And we made the decision that we needed to go to market under a single unified brand with a single unified message. We've made the decision to do that under the Kroll brand. We are now Kroll, same people, same ownership, same great quality, just a new name, Kroll. As you learned in our first episode of our Alternative Asset podcast series, our goal is to delve not only into the nuances of valuation and regulation and governance and other aspects of investor-manager relations or interactions, but to really think about the alternative asset industry globally. And that will be, we're kind of going a little bit broader as we talk today and see how alternative assets fit into the broader investment landscape. In episode 1, we focused on what is fair value and why is it important. And today we want to focus on when and how private investment structures, such as interest in alternative asset funds, whether or if and how they can find their way to Mainstreet. Private investment funds, venture capital funds, private equity, hedge fund, and the like have long been investment vehicles for sophisticated institutional investors and high net wealth or accredited investors. And it's often said that when there's more risk, there's potentially greater return. And private equity investments, because of their illiquidity, because of their private nature, have always been deemed to have something that has more risk, but they have often found their way into defined benefit plans, whether that be pension plans of government entities, public pension plans, or corporate pension plans with defined benefit plans. However, we haven't seen private investments or private investment funds as options in self-directed plans such as 401ks or even IRAs, partly because of their illiquidity, partly because, again, of that riskiness. Ross, as you kind of think about things from a macro level, maybe just both professionally, but even personally, is it potentially a good thing that these type of private investments with their liquidity, with their risk, that they could become more mainstream?
I do, David. As a practical matter, alternatives are an asset class. And so investors are trying to manage their portfolios, diversification of risk, exposure, and the like, I think is an important, let's say, tool, if you will, to have access to, or an asset class to have access to when they're undertaking that task. So by and large, I think this is a benefit to individual investors and not having it limited just to high net worth or sophisticated investors. I think we'll get into the details of each of these, but when I think about reasons for maybe not doing it, we talk about risk, transparency, liquidity. On the risk point, briefly, risk also brings opportunity for return. As investors look for yield and return in their portfolios, having access to the alternative space is a benefit for them to be able to tap into that market. The next piece, I think, is transparency. And we're a far cry from where we were years ago. And even David, when you and I started in the space, it's not a couple of partners in a room with a black box. When I think about what's happened in the industry, I think about sort of the institutionalization of the space, if you will. And that speaks to governance, that speaks to transparency, that speaks to process and the like. So it's a much different industry today than it was 15 or 20 years ago. And the last piece is liquidity. And so what we're seeing now, as we'll get into in the discussion, is new structures that enable investors to have liquidity in an otherwise illiquid product. And I think that helps overcome some of the burdens or hurdles that we would have thought about as an impediment to making this asset class available to the individual investor.
Part of opening the door, so to speak, to more widely allow, and I'll use the term Mainstreet investors, to invest in this alternative asset class was a letter by the Department of Labor back in 2020 that started to remove some of those barriers, allowing at least people to start thinking about how can I move a private investment fund, a fund interest into a vehicle, whether that be a target date fund, whether there'd be some type of RIC, registered investment company, or 40 Act fund that could be established that would have interests that could be, let's say, akin to a mutual fund and be out there for people to be able to invest in. I know that former SEC Chair Jay Clayton said that it's always a good thing to improve investor choice. Of course, investors need to be protected as they do that. As we kind of think about kind of these nuances and look at the alternative asset space, whether that be early stage venture capital or later stage buyout, we've seen at times the asset class has been politicized. There's been, let's say, books written about some of the possibly egregious behavior. But if we kind of look at it now as this is more of an asset class that is really becoming institutionalized, how do we kind of think about that from that investor perspective? If I'm trying to make a decision for a 401k, do I need to have specific type of expertise, Ross, or do you think that the managers can kind of help give me that? And if I have some type of target date fund or a vehicle that allows me to kind of go in that, if I go down the registered investment company route, do I need to be something that I have to educate myself, or will those risk factors be identified? And is that something that you kind of feel like this will feel right, or this will be okay for those who choose to invest?
Yeah, I think, David, I see it as similar to any other investment choice that you would make, whether it's public or private or otherwise. And I think there's a period of gaining comfort with the asset class and a period of sort of training and education, if you will, that would be applicable both to investment advisors and to investors alike. And so I think in the simplest sense, everyone understands, most investors, I would say, understand public securities, public equities, and they know how to price them. They can go look and get a price from Bloomberg or the Wall Street Journal or whatever source they choose. But even then, it still is incumbent upon the investor to understand what it is that they're investing in. Just because it's liquid and easy to value may not make it appropriate for their portfolio, and it's incumbent upon them to do their diligence. I see this asset class as really being no different. And the more common it gets, the more comfortable people get with the asset class, I think the better it is for everybody. But I would still encourage anyone to educate themselves on the risk factors associated with particular assets they're investing in. But again, I think that's true in the public markets as well.
I think that's good insight. And I think as we kind of look at this, and I want to kind of peel the onion back a little bit here in a moment, but there's these type of 40 Act funds or registered investment companies. They come in several different flavors. There's some that are not 40 Act funds that are out there. I know that, for example, we're starting to see even an emergence or reemergence of CFOs or collateralized fund obligations. I think that that's really taking and converting some of the cash flows from the private equity type investments and converting them into a bond desk or a collateralized type of yielding instrument. So there's lots of different, let's say, permutations. There's some creativity going on in this space in looking at how to provide access. Those CFOs maybe give access to insurance companies that have a mandate that they have to really understand the investments that they invest in. And it may be easier to get investment professionals that understand debt instruments or yielding instruments than the nuances of private investments. That's just one example. But as we kind of peel this onion back a little bit, Ross, and kind of as we give greater transparency, In episode 1 of the podcast series, we talked about fair value and what fair value is and why it's important. But as we kind of start now thinking about, all right, if I'm going to take a slice of a fund interest, or I'm going to take multiple slices of fund interests, effectively, I'm going to, as an individual, become a limited partner, so to speak, maybe a step or two removed. But as you think about that, maybe Ross, you can remind us, how are the actual underlying investments valued to get to the value of the fund that eventually gets reported to me as that investor kind of down the path as I'm picking 5, 10, 20, 200 slices of individual fund interests, which indeed in and of themselves have an interest in underlying portfolio companies.
Yeah, David, I think it's good to maybe set the stage too. I sort of started out with the notion of an asset class as alternatives, but I think it's very important to keep in mind that under that umbrella of alternatives, there's quite a wide range of assets that you can invest in specifically. Everything ranging from, as you've described, an interest in an LP position to a direct interest in an equity position to debt, to everything up and down the capital structure and everything in between that you can think of. So quite a wide range of assets that we would characterize as alternative. But helpfully and thankfully, there is a way to value each and every one of them. And actually, there's quite a good bit of guidance in the market today to help us get there. And so we've talked about in previous discussions, our AICPA, private equity and venture capital valuation guidelines is just one, still I can call it new example of that, guidance that sort of covers really the breadth of assets that you see in the alternative space, but sort of taking them in turn. I think the most important thing to understand when you're an investor is what is it that you're investing in? Are you investing in a debt fund, a private equity fund, a buyout fund, infrastructure? What exactly are the securities? But when you get into the specific question around how do you value an interest in an LP, again, the guidance is there both through the FASB and the AICPA, which basically allows you to value that position based on the NAV or the reported net asset value as of the quarter end date. And so there are certain adjustments that you might make to bring it to a current date or in phase, as we would describe it. But ultimately, you're taking your pro rata share of the net asset value of that particular interest. And that's the way that security gets valued.
I think, Ross, you highlight a good point. You have to really know what it is you've invested in. And then there's techniques to value each of those pieces. If we look at this and really say, what is it we're investing in? We, in many of these funds, whether again be an interval fund, whether it be a registered investment company, we will be investing in a slice of a fund interest. And a fund interest meaning that you're take a slice of that limited partner position that has underlying direct investments. So you have a slice of a fund interest, multiple slices of fund interest, and you may have a direct interest in the debt or equity of a particular private company. And in some cases, you may have there may be some of these structures that may have some liquid or actively traded securities. So there could be a kind of a large number of them. But if we could maybe kind of dial in and focus a little bit, because one of the reasons, there's several different reasons why these structures maybe haven't found their way to be used widely. But a couple of those is the overall fee structure, is just to make sure that the fees make sense, kind of that risk and reward, and the managers being remunerated appropriately. So there is a fee structure that differs from, let's say, a typical mutual fund or ETF. But that's one. I don't think we'll dive into that too much today. But we'll really, if we talk about the timeliness of valuation and the frequency of valuation. If we look at fund interests, generally a manager or a general partner reports the value of that fund interest on a quarterly basis, and they do that in arrears, meaning that could be 30, 60, 90, as much as 120 days in arrears. So if we start thinking about that and saying, all right, what does that mean? And how do I value something if it's in arrears? How do I move that, again, from a timeliness and a frequency perspective? Does it make even sense to get to a point where I can value that on a monthly basis, a weekly basis, an ad hoc basis, or even a daily basis? As I've talked to people in the industry, and I mean, you have too, Ross, that there's some out there who strongly believe that it's kind of a fool's errand to even start thinking about things on a more frequently than a quarterly basis. Let's start the kind of macro and then we'll delve into a little bit deeper. But is that a fool's errand to think about things anything other than an in arrears quarterly basis for valuing private funds such as these?
Well, it is the challenge, I think, when you think about more liquid strategies, more widely distributed strategies for the individual investors, so giving people the ability to get in and out on a daily basis. And that really is one of the main hurdles, I think, for these types of structures. But it is a solvable problem, imminently solvable problem. And I think about it really in two phases. I think the first piece is that you need to have the infrastructure in place to deal with both the volume of securities that you would have to address and the timeliness of valuing those securities. So think of a daily basis. So that's the first thing. And the second thing is, well, then how do you go about valuing those specific positions on a periodic basis or between quarterly reporting dates and the like? So maybe taking the first one in terms of the infrastructure, not to be understated, the sort of capacity that you would need to have in order to manage a process like this. So you're thinking about one or two positions, but it could be 50, 100, maybe 1,000 positions. So how do you manage that literally on a daily basis? And so I think it requires having the right support in place, the right procedures in place, the right technology in place in order to get that done. And it comes down to even the most basic things in terms of sharing of information. So how quickly does that information get percolated up to the people that are making decisions on how that's going to impact evaluation? Just to note one example, how do you go through a price challenge on a timely basis when you have a daily reporting requirement? What is the mechanism for that? Does it have to be done that day? Is there a grace period that you can incorporate that information into your valuation conclusions? How do you go through defining a process for final approval of the valuations at the end of the day? And so there are many elements to the process, but again, all these are problems that have solutions. You just have to take them one at a time and work through. But again, I think that is one of the challenges that funds are facing as they think about practical application of making something like this, a structure like this, available. And then the second piece is the valuation side. And again, helpfully, every asset that we've talked about, there is a way to value those particular positions, and it's not a mystery. I think for every security that we've discussed, there are standards and industry guidance that give us comfort in the methodologies that we would use to value those particular securities. So that's not the trick or the concern. The question is, how do you update those on an interim basis? And David, as you point out, are those updates really false precision or a fool's errand? And I think not. I think I break it down as I would anything, and what are the steps that need to be undertaken to make this work? And so when you value a security, any security, you have a start point. Your initial valuation may be from the date of entry, a calibration date. And there are really only two things you're trying to address on a go-forward basis. The first thing is what's changed in the market. And the second thing is how has underlying performance changed. So when you think about this in the normal cadence, we do that on a quarterly basis. We have time to think about it, not a lot, but a little bit of time to think about it. In between quarters, we get financial reporting and other updates. On a daily basis, you're not going to have that. So you need to break it down and think about the market piece first. Are you going to create a model that updates based on the daily change in a set of market comps? That's one way you could do it. If it's based on a discounted cash flow, you could also do the same and update your discount rate on a daily basis. And you could do that in a relatively formulaic way. You could use an index. There are any number of ways you could sort of update for the market performance. And then the second piece is, how do you update for the underlying performance of the particular investment that you hold? And the reality is that you're not going to get new financial information on a daily basis. So there will be days where there's nothing to update on that front because there is no new information. So the things that you have to sort of factor into the system is, well, how do you deal with information that's not recurring nature? For example, the company's filed for a public offering, or there's been some adverse or positive news in the press about the company. Well, how do you deal with that? How do you factor that in to the valuation? And all those nuances can be addressed. And it really comes down to creating a set of algorithms, if you will, for each particular investment as to how you're going to factor in the information that you would anticipate getting for that type of investment. And then having a process in place to incorporate that on a rapid basis. But when you break it down into those two components, it actually is a very doable process.
I think that's helpful. And I think it ties back into the whole definition of fair value. Fair value is the amount that you would receive in an orderly transaction using market participant assumptions as of that measurement date, whether that measurement date is a quarterly date or a monthly date or a weekly date or a daily date. And for private investments, they don't really change maybe as often as we think they do from a value. I mean, private investments don't necessarily have that same volatility that we see in the public markets. And that may sound counterintuitive, but as you said, Ross, private investments kind of have these two legs that drive value. What's happening with the company? What's happening with the market? What's happening with its overall performance in the context of the market and how somebody would see it? If you are valuing it based on a multiple of EBITDA, a multiple of earnings before interest, tax, and depreciation, which is often a way that private investments are valued, or you're valuing it based on a particular yield or discount rate if it's a debt investment, that EBITDA or that yield or that performance, the underlying risk of a debt instrument doesn't necessarily change that much day to day. It may only change monthly as you get new reports. There could be some idiosyncratic information that does need to be taken into account, as you highlighted, Ross, but it's really some of those things don't change very frequently. So it's just being able to react to them and adjust the valuation when they do change. And then having an overlay to say, if the market changes for this type of private investment, can we take that into account on a regular, timely basis, whether that be, again, daily, monthly, or weekly? From a framework perspective, it's been, I think, almost a decade or more ago that the AICPA, the American Institute of Certified Public Accountants, provided guidance on how to think about fair value when you don't have contemporaneously reported net asset value or the value of underlying investments, which, as we mentioned, normally you get that 4 months out of the year or 4 times out of the year at 4 quarter ends, and you get that in arrears. But the AICPA kind of walked us through and gave us some guidance on at least a high level basis that we can use as that overall framework. Ross, can you just kind of touch on that guidance and what that framework does and how do we kind of think about that, kind of dialing it down a little bit on how to practically do this?
As we get into that, I do want to sort of highlight or maybe make the point when you're thinking about putting a process in place to deal with the market and to deal with changes in underlying performance of a position in these interim periods, a 100,000 foot view of the world doesn't really work. I don't think it's appropriate in the fair value context from what you're required to do. Meaning, you couldn't just look at this and say, "Hey, we have 100 direct investments in private equity type positions, and so the S&P 500 moved to 2% last week, so we're going to move the whole portfolio up 2%." You need to take an asset investment specific view, deal by deal, and come up with a methodology for changing that valuation over time. And again, it is tied to an index of some sort, but an index that's very specific to that investment. Or better yet, it's tied to a set of comps that are specific to that investment. So I think as you go through and think about the practical application of what this would look like, it is investment by investment analysis on a daily basis, not hey, we think the portfolio looks like it should be up about 2%, so we're going to market 2%. That would not work. Clearly would not be in compliance with the spirit or the letter of the law under ASC 820. And I think a great example of that is talking about, a net asset value sort of approach. So if you're hold a slice of fund interest and LP interest, and you're allowed to rely on the practical expedient of taking your share of the net asset value, where you can't just take it at face value and leave it at that. There are a couple of things you need to do. One is you need to bring the last reported NAV in phase. And so you would adjust, for example, for things like cash inflows and cash outflows would be the first point. And the second point, which gets into a little bit of a sort of a macro or a process for how you would value on a daily basis, is how do you take into account what's changed in the underlying portfolio on a daily basis when you're only getting reported on a quarterly basis? And there are a couple of ways you could do it. I think one of the main things we would think about is trying to come up with an index that, again, is as specific as you can to the portfolio that you have. So again, if it's a private equity fund, then you would think about, is it a U.S. centered private equity fund? Is it based on a particular industry? Is it healthcare specific, as an example? And come up with an index that you might create yourself based on comparable companies, and use that index as a barometer for changing the market component piece of the NAV on those interim daily reporting dates. So you're adjusting for cash inflows and outflows, you're adjusting for realizations to the extent there's anything in the portfolio that you have visibility into that is public and you can observe that and update based on changes in public prices. You would do that. the balance of the portfolio, you would use an index, I would call sort of a bespoke index, to sort of factor in the daily changes in the market for that particular position.
So, Ross, I think we're coming to the end of our time today. One of the other kind of very macro things that we should touch on, but we don't have time today, is the SEC's new rule on fair value or board governance, Rule 2A-5. I think that's a topic for another day, but I would like to invite you back in a few months to be able to discuss Rule 2A-5. Hopefully we'll have a chance to do that early in the new year. As we kind of look at the takeaways from our discussion today, there's a lot of new funds that kind of fall under that 40 Act umbrella. There's a lot being discussed. Some have come to market, some will be coming to market, whether that be target date funds, whether that be collateralized fund obligations for insurance companies. I think all of these things will provide more choice for investors, both institutional investors and retail Mainstreet investors. I think over time, what this is going to mean for the private fund industry is that GPs will likely probably keep with their quarterly cadence, but they probably are going to get more and more pressure to report more timely, whether that's within days or of quarter end or weeks or as of quarter end. Ross, any more, let's say, final comments from your perspective in kind of this overall, let's say, movement or change in paradigm to more timely, more frequent valuations and more access to private market type investments for many types of investors?
I think it's an exciting development, David. I think, again, the ability for the individual retail investor to have access or better access, let's say, to the alternative space, I think is a net benefit to the industry. And I also think it's somewhat, inevitable, as we've seen the growth in the alternative space, even over the last 10 years, has been incredible and no signs of slowing down. And so I think the sort of evolution to add new participants to the market is somewhat inevitable. And I also think it's great to see that we have so many things in place today, from industry guidance to procedures to best practices, that sort of help enable this evolution along the continuum, becoming more institutionalized. So I'm optimistic about it, and I think it's going to be good for the individual investor as well.
Thank you, Ross. Thank you for your participation. We thank you for listening today. We hope that you were able to join us for our 15th annual Kroll Alternative Investments Conference that we recently held. If not, please click on our website, kroll.com, to find a link to the replay. We welcome your questions and suggestions for future episodes. Please reach out to podcasts@kroll.com. Thank you, Ross, and thank you all for listening. Have a great day.
This was episode 3 of Kroll's ALTLOOK, the Alternative Investments Podcast. Thanks for tuning in, and remember to subscribe on Apple, Spotify, or wherever you get your podcasts. On the next episode, we will discuss how alternative asset funds are taxed and the implications for investors if tax rates change.